This is an analysis from Alpha Business Media.
Welcome to today's deep dive. I want you to picture a scenario. It is the first quarter of 2026. You are sitting in a quiet, climate-controlled boardroom. The doors are closed, the coffee is getting cold, and the CEO looks directly at you from across the mahogany table.
And they ask you one deceptively simple question,
Right, they ask, where do we park our reserves?
which, it sounds like a routine accounting question.
It really does. But in the world we are operating in today, that question is absolutely high stakes. To answer it, we are diving deep into a fascinating new report. It's titled Global Markets 2026: Bitcoin versus Gold, the Institutional Verdict. Our mission today is to unpack the ultimate store of value in a global financial system that, frankly, feels like it is fracturing right under our feet.
And to really understand why that CEO is sweating, you have to understand the macroeconomic backdrop we are dealing with right now in 2026. The world outside that quiet boardroom is anything but calm.
Yeah, to put it mildly.
Exactly. I mean, we're looking at persistent grinding tensions in the South China Sea. Over in Eastern Europe, there is a truce, but it is incredibly fragile. And the result of all this, investor confidence has been completely shredded. The old assumptions about where capital is safe they just do not apply anymore.
Okay, let's unpack this, because going into 2025, we were supposed to have this all figured out. We had the G20's great regulation of crypto last year. That was aggressively billed as the moment digital assets finally grew up.
That was the pitch, yes.
It was supposed to bring regulatory clarity, bring Wall Street into the fold, and make everything neat and tidy. But reading through this report, it seems like instead of solving the global capital problem, it just created an entirely new, incredibly complex battlefield.
Precisely. The landscape of what we consider a safe haven
Yeah.
has shifted dramatically. And the regulations actually altered the DNA of these assets in ways people really didn't anticipate.
So today, we are going to examine the two heavyweights fighting for space on the corporate balance sheet.
Right. In one corner, you have gold, the ancient traditional hedge, and in the other, Bitcoin, the newly regulated digital challenger.
And then later on, we are going to take all of this high-level macroeconomic theory and apply it to a fascinating real-world stress test. We're going to look at the daily reality of a corporate treasury operating in Nepal.
Which is a completely different world.
I cannot wait to get into that Nepal case study because it completely flips the script on how we view risk. But let's start with the biggest financial story of 2026. And spoiler alert for you listening, the biggest story isn't the price of Bitcoin.
No, it's not.
It is the massive, highly disciplined, almost relentless buying of physical gold by the world's central banks. We're talking about the People's Bank of China leading the charge, closely followed by institutions in India, Turkey, and Poland.
Huge buyers right now.
But why? I mean, in an era where we can beam billions of dollars across the globe in a microsecond, why are the most sophisticated financial entities on Earth reverting to hoarding shiny rocks in a basement?
Well, if we connect this to the bigger picture, you realize very quickly that these central banks are not day trading.
Right.
They are not looking at a price chart, hoping for a quick return on investment. This is not a speculative bet for them. It is a geopolitical statement. They are buying an insurance policy against financial sanctions.
The report mentions this term, the tangibility premium. What exactly are they paying a premium for?
They are paying for an asset that exists entirely offline. The tangibility premium is the value derived from an asset existing outside the digital financial system. I mean, think about the modern banking system.
It's all digital.
Exactly. Most of the world's money is just entries on a digital ledger, moving through networks like SWIFT.
Let me stop you there just to make sure we are all on the same page. For anyone who doesn't track global banking plumbing on a daily basis, what is SWIFT and why does a country want to avoid it?
SWIFT is basically the messaging system that banks use to securely send money across international borders. It's the central nervous system of global finance.
But there's a catch.
A massive one. Because it is heavily influenced by Western powers, it can be weaponized. If a nation falls out of favor, a SWIFT directive can essentially freeze their digital assets with a few keystrokes. They are suddenly locked out of their own money.
So holding physical gold is a direct countermeasure to that.
Absolutely. If a sovereign nation holds physical gold in a vault within its own borders, that asset cannot be frozen by a SWIFT directive. It cannot be seized or locked up by someone pulling a lever in New York or London.
Which gives them total control.
Yes, as the report brilliantly puts it, physical possession is 10/10 of the law. It is the ultimate non-digital asset. For nations prioritizing strategic autonomy and de-risking from the U.S. dollar system, gold is the only asset that guarantees counterparty risk is zero.
And counterparty risk being the risk that the entity on the other side of your screen won't honor the deal.
Exactly. With physical gold, there is no screen.
It's so counterintuitive. Everyone pushes for cloud computing and instant digital settlement, yet the most powerful players on Earth are falling back on heavy, boring physical metal precisely because you cannot put it in the cloud.
It is a profound shift in global strategy.
But let's look at the other side of the coin. Let's talk about Bitcoin and what happened after the Great Regulation of mid-2025.
Ah, yes. The turning point.
This was the moment the US and Europe established clear rules. They approved spot ETFs, meaning Wall Street funds could finally buy and hold the actual asset for their clients, and they unlocked literal trillions in institutional capital. The whole pitch was that this would mature the asset, make it safe.
Right.
Did that completely backfire?
What's fascinating here is the paradox that emerged from that regulation. The regulation was absolutely designed to reduce systemic risk, weed out the bad actors, and protect institutional investors.
Makes sense on paper.
But the actual outcome, regulation did not tame Bitcoin's volatility at all. It institutionalized it.
The report calls this financialization. But how does that actually work? Wouldn't pouring billions of dollars of boring traditional institutional money into Bitcoin naturally stabilize the price?
You would think so, but it had the exact opposite effect. Before all this regulation, Bitcoin's price was driven by a chaotic mixture of retail investor sentiment, countercultural ideology, and opaque offshore trading.
It was its own weird island.
Yes, it didn't care what the traditional stock market was doing. But post-regulation, because it is now bundled into Wall Street ETFs and derivatives, it has become massively correlated with mainstream risk assets. It behaves like a high beta tech stock on steroids.
Okay, for the non-traders listening, explain that high beta concept. What does it mean for the asset's behavior?
In finance, beta measures how much an asset swings in relation to the overall market. So if the stock market drops 1%, a high beta asset might drop 3 or 4%.
It amplifies the movement.
Exactly. Bitcoin's price movements are now exaggerated reflections of the broader market. When the U.S. Federal Reserve even hints at a change in interest rates, or when standard macroeconomic data is released, Bitcoin reacts instantly and violently.
Because it's tied to the broader system now.
Yes. Its price is no longer driven by a grassroots movement. It is driven by algorithmic trading and institutional options expiry dates.
The analogy the report uses is just perfect. It says that now, when the traditional financial system sneezes, Bitcoin catches pneumonia.
It is a vivid image, and it highlights a severe problem for anyone running a business. Think about why you, as a company, hold a hedge in the first place.
To protect yourself when things go wrong.
Right. A true hedge is supposed to be non-correlated. It should strengthen or at least hold its ground when your primary business operations are facing macroeconomic headwinds. But this newly regulated, institutionalized Bitcoin acts as an anti-hedge.
Because it does the exact opposite of what you want an insurance policy to do. It thrives on risk-on sentiment.
Yes, it loves cheap money in booming markets.
But if the markets are booming, your company's probably already doing great. The moment there is a panic, a risk-off flight to safety, when credit dries up and you desperately need your treasury reserves to be rock solid just to keep the lights on, that is exactly when Bitcoin plummets.
Which brings us to the operational reality of holding these assets. It's one thing to debate this at an economic forum. It's another entirely put it on a corporate balance sheet.
Here's where it gets really interesting. I want you to mentally step into the shoes of a chief financial officer right now. We are leaving the grand macroeconomic theory behind and looking at the actual accounting.
The nuts and bolts.
Exactly. Because a corporate treasury is not a hedge fund. It is not there to make speculative bets. Its entire purpose is to guarantee there is cash for payroll, cash for suppliers, and cash to service debt. So walk me through the accounting. If I'm a CFO, why is gold considered a safe play from an accounting perspective?
Let's run the numbers. If you hold gold on the books, where legally permissible, of course, it is typically recorded as a non-current asset. Its value is historically stable, and it introduces almost zero volatility to your quarterly earnings report.
Okay, but it's not perfect.
No, it has downsides. It generates zero yield, meaning it doesn't pay you interest while it sits there. And liquidating a ton of physical metal is slow and expensive. But it preserves capital perfectly. It is boring, predictable, and stable. And if you were a CFO, Boring is exactly what you want your reserves to be.
Now, contrast that with holding Bitcoin on a corporate balance sheet. The report highlights that because Bitcoin is an intangible asset with an active 24/7 trading market, it falls under mark-to-market fair value accounting rules.
The bane of a treasurer's existence.
Explain this to me like I'm running a manufacturing company. Why is that accounting rule such a nightmare for my business?
Mark-to-market means that at the end of every single quarter, you have to report the asset's current market price on your official financial statements.
Even if I haven't sold it.
Even if you haven't sold a single Satoshi, it is just sitting in your digital wallet. But the wild swings of the crypto market flow directly into your company's profit and loss statement, your P&L.
So imagine your company manufactures cement. You have a phenomenal quarter operationally. You sold a record amount of cement. Your supply chain costs are down. Your staff is performing perfectly.
A textbook perfect quarter.
Right. But because Bitcoin's price happened to crash by 30% that month, and you have to mark that loss on your balance sheet, you suddenly have to report a devastating financial loss to your shareholders.
Exactly. Your core business is thriving, but your official financial statements look like an absolute disaster.
Mm.
And this isn't just an optics problem for your shareholders. It can trigger very real, immediate consequences,
Like what?
like breaching the covenants on your corporate debt.
Let's pause on that because that is a massive consequence. For anyone who hasn't stared down a corporate loan agreement recently, what does a breached covenant actually look like on a Tuesday morning for the cement company?
When a bank lends a company money, they put rules, covenants, in place. For example, your total assets must always remain a certain percentage higher than your debts.
A safety buffer for the bank.
Yes. If you take a massive paper loss on Bitcoin because of mark-to-market accounting, your total asset value plunges. You technically break the rules of your loan.
Oh, wow.
The bank can immediately demand full repayment of the loan, freeze your credit lines, or force you into restructuring. Your company is suddenly fighting for survival, not because you couldn't sell cement, but because a digital token dropped in price.
That is terrifying. And I assume the reverse is also true. You could have a terrible quarter making cement, but show a massive profit because Bitcoin rallied. It completely divorces your financial statements from your actual business performance.
Precisely. Because of this P&L volatility, the report is incredibly clear. No sensible bank will lend against Bitcoin on a corporate balance sheet. No board of directors can confidently plan a budget for the next year if the reserves might randomly drop by 40%. For a corporate treasury, Bitcoin introduces severe risk. It does not mitigate it.
So what does this all mean? We are sitting here in Q1 2026. Which way is the wind blowing? The report outlines two very distinct scenarios for the global system, and corporate treasurers are essentially placing a bet on which future we are heading into.
Right. Scenario one is deepening geopolitical fragmentation. In this world, the U.S.-China rivalry continues to intensify. Regional conflicts do not resolve, trade wars escalate, and the global push for de-dollarization accelerates.
A fractured world.
Very much so. If you believe this is our reality, gold wins outright. Its physical, sovereign nature makes it the ultimate safe harbor. Central banks will keep buying, placing a firm floor under the price, and Bitcoin will be sidelined as a speculative distraction and a potential target for state-sponsored cyber warfare.
And then there is scenario two, a coordinated global recovery. This is the highly optimistic path. Geopolitical tensions magically ease up. Central banks manage a perfect soft landing for the global economy.
A return to normal.
Right. In this world, the risk-on appetite comes roaring back. Institutional money floods into those newly regulated Bitcoin ETFs seeking massive growth. And in this scenario, gold gets dismissed as a barbarous relic of the past because the world is healing and people want high yield, not just safety.
But we have to look at the board as it is played today. The verdict for Q1 2026 is that our current global reality looks much, much more like scenario one.
Fragmentation.
Yes. And therefore, for corporate capital preservation, gold remains the vastly superior asset.
There is a line in the text that I think perfectly encapsulates everything we've just discussed regarding the CFO's dilemma. It says, "The purpose of a corporate treasury is to survive the storm, not to surf the wave. Gold is the storm shelter. Bitcoin is the surfboard."
That is fantastic.
Isn't it? If you are managing a company's lifeblood, you don't grab a surfboard when a Category 5 hurricane is approaching.
That is an excellent way to summarize the institutional perspective. But we need to apply this to a specific real-world context that fundamentally changes the nature of this entire debate. Because for a massive portion of the world, this binary choice between gold and crypto is a luxury they frankly don't have.
Yes, the plot twist of the report. We are going back to that boardroom, but specifically a boardroom in Kathmandu, Nepal.
A very different environment.
The report spends a significant amount of time here, which surprised me at first. But for a Nepali CEO or CFO, this entire Bitcoin versus gold debate is essentially a massive distraction from their actual day-to-day survival.
To understand why, we have to look at the local macroeconomic structure. The Nepal Rashtra Bank, the country's central bank, does hold gold reserves, but they aren't playing the geopolitical chess match the People's Bank of China is playing.
What are they doing with it then?
For Nepal, those gold reserves serve as a vital psychological and financial backstop to maintain confidence in the Nepali rupee's strict peg to the Indian rupee.
And what about the corporate side? If I'm a Nepali treasurer, can I just load up on Bitcoin ETFs?
Not at all. Cryptocurrency trading is officially banned in Nepal under the Foreign Exchange Regulation Act, so they couldn't buy the surfboard even if they wanted to.
Right.
But even if it were entirely legal and regulated, the report points out that the true boss battle for these companies isn't choosing between a digital tech stock or physical metal.
So what is the actual existential threat keeping that Nepali CEO awake at night?
Currency depreciation. The Nepali economy is highly dependent on imports. Whether they are manufacturing goods or building infrastructure, they constantly need raw materials from overseas.
And those suppliers don't want local currency.
Exactly. International suppliers demand U.S. dollars. If the Nepali rupee depreciates against the dollar, the cost of their imports skyrockets overnight. Therefore, the true store of value for these enterprises isn't a shiny metal or a digital token. The ultimate store of value is quite simply access to foreign currency.
Put yourself in the shoes of that Nepali CEO. You don't care about the geopolitical chess match between the US and China. You care that you need to buy raw materials from overseas tomorrow, your suppliers demand US dollars, and your own government makes it incredibly difficult for you to hold on to those dollars to hedge your risk.
That is a completely different kind of financial fear.
The report points directly to the Act to regulate and control foreign exchange, which was updated in 2019, and enforces strict capital controls. Why were these put in place, and how do they choke a modern business?
From a state level, these laws were designed to protect the national reserves. A developing nation needs to ensure it doesn't hemorrhage foreign currency. But on a corporate level, it means these businesses cannot easily hold, transact, or stockpile the U.S. dollars they desperately need to hedge their import risks.
They are restricted.
Yes, they have to constantly navigate bureaucratic hurdles just to pay their basic operational expenses.
So while a U.S. company is debating whether to put Bitcoin on their balance sheet to chase yield, a Nepali company is fighting just to hold enough dollars to pay for next month's steel shipment.
Exactly. The report concludes that the most impactful strategic move for Nepal's business community isn't building massive new gold vaults, and it certainly isn't lobbying to legalize volatile crypto trading.
So what is the solution?
The solution is advocating for a phased, highly intelligent liberalization of those capital controls. Because right now, until a Nepali firm can manage its foreign exchange exposure as freely as its competitors in India or Bangladesh, they are fighting a brutal global economic battle with one hand tied firmly behind their backs.
It's a sobering reality check. We spent all this time debating the high-flying concepts of digital financialization and sovereign gold hoarding, but down on the ground, the friction of local law and access to basic foreign exchange is what actually determines if a company survives the quarter.
This raises an important question about how we actually define risk. True risk management requires looking past the hype of price charts and Wall Street ETF approvals. You have to understand the underlying, often boring mechanics of global finance.
The local accounting rules?
Yes, the accounting rules, the legal clarity of the jurisdiction you operate in, the tangibility of the asset, and your fundamental regulatory access to liquidity. Those are the gears that actually turn the global economy. What is a safe asset for a superpower is completely irrelevant to a mid-sized manufacturer facing strict currency controls.
So let's recap this incredible journey for you. We started by looking at how the world's biggest central banks are flexing their geopolitical muscles by hoarding physical, offline gold. They are paying a tangibility premium as a direct shield against the weaponization of digital banking systems like SWIFT.
which is a massive trend.
Then we looked at how this great regulation of 2025 paradoxically turned Bitcoin into a highly correlated, volatile tech stock that introduces absolute nightmare mark-to-market accounting scenarios for any CFO trying to protect their balance sheet.
The anti-hedge.
Exactly. And finally, we grounded all of that in the stark reality of Nepal, where basic capital controls make access to foreign currency the only store of value that truly matters for business survival.
It perfectly illustrates that in a fractured world, context is everything. You cannot apply a one-size-fits-all solution to corporate reserves.
It is a phenomenal report that really reframes how we think about money, risk, and stability in 2026. And I want to leave you with a final thought to mull over, building on everything we've just discussed. The source material hammered home the incredible importance of that tangibility premium, the idea that physical possession is the ultimate security. We saw it with gold. But as this global fragmentation deepens and supply chains become increasingly weaponized, will the ultimate store of value for future corporations shift away from traditional money and financial assets altogether? Could we see a future where the safest place to park corporate reserves isn't in a bank at all, but instead becomes the direct hoarding of physical commodities, energy resources, and proprietary supply chain infrastructure, just to guarantee they can keep the lights on and the factories running?
A complete shift from financial hedging to operational hoarding. It is a very compelling and, frankly, very realistic question for the years ahead.
Something to keep you awake tonight. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking past the headlines, and we will catch you next time as we continue to unpack the forces shaping our world.